Burnout to All Out fam, I am so excited for you all to get a chance to hear from the cream of the crop. These are our Burnout to All Out Elevate 360 mastermind clients who've been in my mastermind, high-level mastermind, all year this year. And we do a summit once a year with our mastermind clients to debut their zone of genius. What is incredible is that these clients all embody a 360 degree approach to business. They all contribute in one way, shape, or fashion as subject matter experts that contribute to the pillars of Elevate 360, which is truly that we believe that bodies build businesses and that we have to have business strategy and legacy strategy as well. And so what is really cool about these clients is that through a series of a couple of days of a summit, they were able to highlight and bring value and educate in their fields, whether it was around self-leadership, leadership in business, business strategies, energetics and mindset, and or legacy, and how we take what we're doing and make our money work harder than we did for it to create impact and legacy over time. And so they really embody all that represents the 360 degree approach to business and the Burnout to All Out through line of our mastermind. So over the next couple of episodes, you are going to hear from all of these experts. You're going to get the details to their work in the notes section. And hopefully you're inspired as well as to what is possible for you as an entrepreneur in scaling your businesses the way these incredible human beings have. So hope you enjoy the series. So excited to bring our next speaker, Julie Eccleston, to the room. Let me give you, again, her formal bio as a member of Elevate 360 Mastermind. Julie is both a seasoned sales manager for one of the nation's largest national lenders and the visionary founder of Homeownership U, where she helps buyers prepare for home ownership with confidence. With nearly 20 years in mortgage lending, Julie blends expert strategy with heart-led guidance. Her mission is to make the path to homeownership clear, empowering, and achievable for everyone. This is astounding, the statistic that she has here. There's approximately 34.8 million small business owners in the United States, which accounts for almost half the U.S. GDP. However, when applying for a mortgage, 49% are denied. 49% are denied. In her presentation today, Julie will walk you through what underwriters are really looking at and how to understand your tax returns and how to prep like a pro to get you approved. So Julie, love this topic. I know you and I were talking about this on our one-on-one the other week. I was like, this is dead on. I think this is one of the reasons some people are risk averse to going into business for themselves, because if it's not health insurance, it's funding for their first home, because if they're not backed by a W-2, they feel like there's no security, right? So excited for you to bring forward this topic today. And I'm going to turn it over to you, my friend.
Awesome. Well, thank you so much for that introduction. Welcome to Hustle to Homeownership. And for so many within this community who I know are either starting their self-employed journey, they're solopreneurs, they're, side gigs, side love, whatever we want to call it. Sometimes when it comes to qualifying for a mortgage, it's not as easy. And Melissa's right. 34.8 million small businesses in the United States. That's actually over 90% of all businesses within our country, and makes up 46% of the private sector and half of the US GDP. So obviously, when we are thinking about small businesses are like absolutely the backbone of our economy, but nearly half the time, you are getting denied. Self-employed business owners are getting denied. And in comparison, that is 12% is what everybody else is. So I'm Julie Eccleston. As Melissa had shared, I am a sales manager. I'm an executive loan officer. I've been in the business for over 18 years, almost 2 decades, which is funny because some days I still feel like I'm 18. But during that tenure, I've done a little bit of everything. One, been client facing. Two, I currently lead a team of roughly 5 bankers, but have led up to 25 to 30 before. And most importantly, I actually spent 3 years as a suspense analyst. And that role within our organization is a role where we work on files that maybe have gone like off the rails a little bit to find ways to get them back on track. So I've worked a ton with self-employed homeowners and borrowers, and over 1,500 of my own families that I've personally served over the last 2 decades, not to mention, the tens of thousands that I've helped only as an underwriter as well as with the teams that I'm leading. So my goal today is to help you understand what lenders are really looking for and how to set yourself up for success. So first things first, we're going to talk a little bit about lender logic. What is an underwriter and what are they looking for anyways? So simply put, regardless of what type of loan you are looking for, if you're self-employed, if you've got passive income, if you're a W-2 employee, there's 4 things that come down that are analyzed: your income, your assets, your property, and your credit. And the role of an underwriter is simply to go through, take everything that you or your loan officer tell them and evaluate the risk. They want to know, 1, does this client have the ability to pay? And 2, do they have the desire to pay the loan back? Think of it this way. Think of the last time you went out for brunch or drinks with your friends. You put it on one tab. You said, great, Venmo me later. I bet you know out of that group of friends, which ones are going to Venmo you before you ever hit to the parking lot, which one you might need to give a gentle nudge to, which ones you're definitely going to give gentle nudges to, and which ones that you just went ahead and donated to their brunch fund because you know you're never going to get that money back. So you're probably thinking to yourself, well, Julie, but I'm the one, like I'm the Venmo, like I'm before the parking lot, like that is me. Why is there such a gap of being able to get approved for a loan? Well, if you look at most loan programs, current underwriting guidelines are just looking at the last 2 years of tax returns, and they're only going to take into account the bottom line. So irregular income, if you have lots of write-offs, a lot of times that is going to result in low taxable income, which is going to make it harder for self-employed borrowers to go ahead and qualify. Your risk appears higher unless, 1, you're working with the right loan officer, and 2, you have it clearly documented. Because not all self-employment is created equal. As a lender, we're not just looking at like what you make, your pocket money, what actually is necessarily going into your bank account. They want to know how long and how consistently you're making that money, and that you've been making it and you are claiming it on your tax returns. Now, one of the biggest things I always hear from a lot of my self-employed clients who are, just branching out and just starting is like, look, like I'm going to make all of this money. But one thing that we do have to remember is that unfortunately, within the first year, 20 to 25% of small businesses fail. And within the first 5 years, almost half of them shut their doors, which is why underwriters, banks, lenders often rely on what that income is that you are showing to the government through your tax returns. So I'm going to give you a little bit of a pop quiz. I don't need you to answer. There won't be a grade, but just think about it to yourself for a second. In your business, what did you make last year? Maybe write it down. Just think about it for a second. And then your follow-up to that is, now how does that compare to what your tax returns say? When it comes to write-offs, when it comes to things along those lines, there's often a pretty big disconnect between what actually came into my bank account and what I paid taxes on. So what we're going to do today is I'm going to show you how to structure your finances like a lendable business so we can get you from the sidelines and into home sweet home. Step 1 is to really understand where you are in your self-employment journey. Maybe you're just starting out, you're someone like me. I have a W-2, I've got my side hustle. Maybe then you're newly self-employed, so we're less than a year. Then we're going to progress to a 1 to 2 years self-employed, and then 2 years plus. So if you're in this W-2 with a side hustle, so you're working full time, you've got a passion project, you're starting to maybe earn some income through that business. Maybe you're not yet earning income through that business, but doing freelance work, whatever the case may be. This is a great time to get approved because your W-2 income will be your qualifying base. Now, one caveat I will say is like, do the right thing, right? It's not get house, quit next week. But if you are ramping up your self-employed journey, being able to do that, awesome. And your side, because your side income, you usually need 2 years of history to count. Now, I don't know about you guys, but when I started mine, I had some loss on my tax returns, which I did appreciate at tax time. And the good news is if and when you are using W-2s to qualify, that loss doesn't have to be counted into your income on most loans. So this is a really, really great time to say, okay, I'm going to start looking for a home before I maybe transition into full-time self-employment. So at this point, really start building your books, right? So keep your business deposits in a separate account, really start tracking your income and expenses monthly, file your taxes so you're starting to get a history, and report that side income, even if it's small, even if it's a loss. Because right now we're thinking ahead. We want to make sure if we want it to count later, we want to be able to go ahead and do it now. Now we're newly self-employed. Maybe it's less than a year, right? So you've recently left your job to go full-time on your own, either 1099 work, maybe contract work, and you've done this all within the past 12 months. A lot of our traditional programs are going to require 2 years of self-employment history. But if you are in the same field, you may actually be fine. You may be able to go ahead and move forward. For many of you, you may not likely be mortgage ready, but can be with a strategy. So this is a really great way to start thinking. And the reason why I say that, and I'll give you an example. Let's say you're a therapist, you're working W-2, you're working for a firm, and you say, you know what, I want to go out on my own. I want to see my own patients within my own setting. You've been doing this for 20 years. If you have self-employment income on tax returns, even if it's for 8 or 9 months, but you've been in that role, chances are you may be able to qualify. You are just going to have like a more aggressive calculation. So it's not going to give you credit for all of your income. So at this point, we're really going to start building a solid paper trail. You want to make sure that you're working with a lender early to get a game plan and ensure that you are partnering with a mortgage savvy CPA. We all love our CPAs when we go and they whittle that big number down to like a little number. But then so many times clients come to me and they don't love their CPA as much when either we can't qualify them for what they need or we can't qualify them for all because we did a lot of whittling. So 1 to 2 years in, you're rolling, you've got a full year of self-employment under your belt, you filed at least 1 year of tax returns. We now have options for traditional programs, right? And you can take those tax returns and that experience in the field and you can qualify for traditional programs. Now, a lot of times you're going to go to a bank, maybe you're going to go to a community lender and they're going to say, nope, 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 nope. You need 2 full years of self-employed. I will tell you 2 is the magic number when it comes to mortgages. But that is not necessarily correct if we can document a trail of expertise and experience relating to what you're doing now. Remember, the whole reason we ask for all of this is from an underwriter, from a lender, we want to ensure that you've got the ability to pay back and the desire to pay back because we have a history of being able to make this income and candidly for you as the borrower, as someone who is looking to purchase a home. The last thing I ever want to do is put someone into a position where maybe they're in a little bit over their head because being self-employed and having to be on a variable type of income is a lot different than just steady every week, every other week, I'm getting the same exact check. So 1 to 2 years self-employed, making sure that you are updating your profit and loss regularly. You're monitoring your income. Is it increasing? Is it decreasing? Is it holding steady? This is just kind of a good word to the wise. If you have declining self-employment income, that does raise some red flags. You will need some more documentation for that. So being able to, one, take a look at, hey, where am I at now? Or where am I progressing? And then two, also being in a position of understanding that as you are getting ready to do your next year's tax returns and really being able to see where your losses are, where your losses aren't, and to ensure that you aren't necessarily having like a major decline, because that is a really, unfortunately, a big reason why a lot of self-employed borrowers do get denied. So you may also want to consider delaying some major deductions to show a stronger net income and make sure that you are organized. To your self-employed, the world is your oyster, right? You now have access to every single program that's out there because you have met the magic 2-year mark. So most loan programs are going to be accessible for you, but the biggest thing is going to be consistency year over year over year. If we're seeing big swings, mostly negative swings, no one's sad if you're making more money. If we see big swings in declining income, it really is going to raise flags and require some explanation. So knowing that before you're heading into a mortgage process is so important, because the last thing anyone ever wants is for you to go find this absolute beautiful home, love it, want it, fall in love with it, win out on multiples, just to find out that either one, you can't get qualified for it, or two, we're going to ask for blood samples in your firstborn child to be able to get you approved, and the amount of documentation that you have to provide. So making sure that you are just reviewing your last couple of years of tax returns. Are they consistent? Keep clean records and really get fully underwritten before you are shopping. In this market, in today's day and age, I tell everyone, get a full verified approval. That's what we call them in the organization that I work for, where your income, your assets, your credit is fully underwritten before you ever walk in a door. And it's important if you are a W-2 employee, but candidly, if you're making $200,000 a year on a W-2 and you've got $100,000 in your bank, anyone can close that loan for you. But if you are self-employed, if you have nuances to your situation, it's so crucial that you get fully underwritten before you ever start shopping for a home, because no one wants you to break your own heart. So regardless of where you are in your journey, if you're just starting W-2, you got the side hustle, or you are full boss status, I've been doing this for years, it's so important to ensure that you've got a plan, you've got a timeline, that we have an accurate, updated profit and loss statement so you're not scrambling at the last minute, that you're keeping your documents organized, and you're keeping your credit score high. Be very mindful that you have no non-sufficient fees on your bank statements, and document any irregular income sources. Now that QR code is going to give you a link to a toolkit, and if you can't, the link is below, where it talks about all the different documents that you'll need based on the business that you have. Now, a lot of folks think like, oh my gosh, well, my W-2s, or I'm sorry, my tax returns do not accurately reflect what it is. In the housing market right now, you guys, it's coming back to a buyer's market. So if you are looking to buy a home, it is a good time to really start to consider that if that's something that's on your goals for 2025 or 2026. Biggest thing is just making sure that you've got your documentation and that you're keeping things consistent. So you might be thinking, well, that's a lot. And how do I know what loan is right for me? So to boil it down, there are 3 different types of loans, 3 different categories. We've got our conventional loan, who are Fannie and Freddie, the big mama and papa of the mortgage industry that we're hearing all about in the news in today's day and age. We've got our government backed. So these are your FHA, your VA, your USDA, which are for rural properties. And then we have this third category that is called non-QM, or non-qualified mortgage, right? Qualified mortgage is something that came about in 2009 after the crash. But these are programs that will allow you to use alternative documentation, really open the door for getting you approved, whether it just means using assets as income or just using bank statement deposits or profit and loss statements to be able to qualify for a loan. So conventional, government-backed, FHA, these are awesome if you've got a W-2, or like Melissa was talking about, you have a cosigner with enough W-2 income to cover debt ratios. Maybe you get a pension, maybe you get Social Security, maybe you have trust income. Great, fully document it, we're good to go. This is where you should always start, because your pricing is always going to be best on these programs. If you don't fall into these categories, this is where you want to look at non-QM, right? You don't fit the traditional mold, you don't fit the traditional model, and that's okay. So maybe your tax returns don't accurately reflect the income you really are making through the business, or you're purchasing a property that is actually cash flowing. You can use that through different loan types, or you have substantial assets, but you're not taking draws. You can actually use a calculation to say, great, I've got $2 million in the bank. I'm buying a 20-year loan. We can use this and use that as income to get you qualified for a little bit more. This is why knowing who you're working with and working with someone who understands the landscape and understands tax returns is so, so, so important. So here are a couple questions that I would ask any lender that you're choosing to work for. And again, I would encourage all of my clients to ask these. And I have also included these questions in the toolkit as well. And I will show this QR code at the end as well. So if you don't get a chance to take a picture now. 1, will you do a full underwrite upfront? Again, this is going back to that verified approval. Knowing that you are not going to have any issues with getting your financing takes so much stress off of the process, and it makes you a stronger borrower. Because at the end of the day, I might know that you qualify, you might know that you qualify, but that seller does not know that you qualify. And if they're going to accept your offer and take it off the market, they want to know, hey, I'm not going to have to just put this back on 10, 15 days later because this person can't actually buy this house. 2, do you offer loan programs for entrepreneurs, right? We just talked about there are so many different types of non-QM, profit and loss loans, bank statement loans, asset depletion. Sometimes your smaller banks and even larger banks don't offer these. It's not within what it is that they do. And that's okay. You might talk to someone that type of an establishment, and they might say, sorry, Mr. and Mrs. Client, like, unfortunately, you don't qualify. That doesn't mean you don't qualify for a loan. It just means you don't qualify for what they offer. And if they don't have some of these other programs, that's okay. You can find them elsewhere. 3, how do you calculate self-employment income? Now, this one's a little bit of a passion question for me. There are a lot of folks out there within the mortgage space who will say, yeah, Mr. and Mrs. Client, oh my gosh, I can totally help you. Send me your tax returns. Great, go find a house, and literally take them and say, here, assistant, I need you to calculate this. Here, underwriter, I need you to calculate this. Just do this. Now, that's great. You should have a support team that is going to help you. But I look at it as like when I am choosing to do business with someone, I am putting my trust in you, my person, to get me through to the finish line. I want to know that you have the expertise to actually do that for me, not just pass it along. Because if we have to pass it along to someone who knows what they're doing, then quite frankly, in my world, I just want to work with that person. So asking them questions of like, what is your process? How am I assured that the person that I am working with really understands, my situation, and I'm not getting that fourth quarter call of, sorry, we messed up. I get a lot of those calls from clients who move forward with other lenders who then say, oh my gosh, Julie, can you help me? And half the time we can, half the time we can't. 4, how many self-employed borrowers have you closed with, and can you provide references? Now, again, I've been doing this for almost 2 decades. I coach a lot of young, just starting bankers, and I like to be at the front end of a lot of things. The thing I don't want you practicing on, though, are my finances. So asking, have you done this before, right, is a really, really appropriate question. Just like, if I'm having heart surgery, I don't want to be that person's first patient. If I'm buying a house, I don't want to be the first set of tax returns that you're going through to try and close this loan when I probably already have tens of thousands of dollars on the line. And then lastly, why did you recommend program X versus program Y? And I will give you a very specific example before we kind of end out and head out. So I had a client, lovely client, past client of mine, and she qualified. We could fully verify her income. And then she also just inherited 2 businesses, and we could have gone either route. And we actually ended up doing a non-QM bank statement loan for her because it gave her better pricing. So asking the question of like, hey, Julie, like, why are we doing this versus that is super, super appropriate. A lot of bankers and lenders will just say, hey, we're going to do a bank statement loan because you own 4 businesses and I don't want to have to go through all those tax returns. So asking those questions to kind of dig a little bit deeper. And then lastly, 3 tips. 1, have a plan. Make sure that you've got the right team before you're ready to buy. 2, keep your separate bank accounts, keep track of your business expenses, and make sure you're being consistent with those payments. And then have your documentation ready to go before you call your lender or start looking for houses. So thank you so much. I hope that this was helpful. I know I have just a couple seconds. If someone has questions, I'm more than happy to help. And if you follow that QR code, you'll have 2 things. 1, you're going to get a link where you can download the toolkit, which talks a lot about those documentations. There's also an option on there too to book a complimentary 20-minute, strategy session with me. Ask me your questions about where you are in your business, what you should do, so we can put together a plan. So if homeownership, whether it's buying a home, whether it's refinancing, as we are starting to see interest rates come down, or something that are in your future, we can make sure that you're set up and ready to go so you can take advantage when the timing is right.
Yay, Julie. Okay, there was a question in the chat and now I can't find it. And I said, I'll ask. Oh, here we go. Can this advice be applied for home equity or refinance on rental properties as well for self-employed?
Yes, 100%. So if you are self-employed and have a rental, there's kind of 2 different ways. Either 1, yep, you can do this on an investment property and do like a bank statement loan or non-QM, or there are also something called a DSCR. You guys, I think I'm dyslexic. I always get those different, where basically you just take the cash flow of your property. If it's an investment property and you're buying it more from like a business to business, you can just take the cash flow. It doesn't necessarily you, but this is where documentation becomes so, so, so important. And I know you guys, it feels like we're asking for a lot. Candidly, we are asking for a lot because don't forget, like we have to go through these documents too. So it's not because we like to do it, but really to be able to go through and get you the answers that you need.
So informative and so detailed for the entrepreneur. This is like the niche information that so many people need, Julie. Thank you so much for sharing. Before we wrap up, I'm going to ask you the question I've been asking everyone as an Elevate 360 Mastermind member. How are you embodying the 360-degree approach, 90 miles an hour right now with the market the way it is?
Yeah. So, what I thought was really interesting. So obviously, like I've been in your community for a while. I've had this idea of really helping homeownership and first-time homeowners. That is a huge passion project of mine because financial literacy is not amazing always in our country. But I stalled out for so long and I just didn't do it. I mean, it's been years and I just didn't do it. And so I think the biggest realization for me is like, it's not that I don't know what I'm doing. It's not that I don't have the drive. It's not that I don't even like doing this stuff. It's just you got to fix the inner work before you do the outer work. Was, and probably to a point still is, like something that was really blocking me to be like, screw it, like I'm going and I'm going to do it and we'll figure it out, right? And we'll kind of jump right in. So I have thought that was like really interesting that when you look at business, and especially when you take so much pride in what it is that you do, and that your business is so much of just kind of an identity of who you are as a person, that you can't separate the inner from the outer, and you've got to really make sure that you're doing it the right way, which I was not expecting.
So powerful. I mean, that's a huge piece, right? Like I often say, and I don't know if you would agree, but entrepreneurship in itself is one of the like biggest personal development growth journeys that we discover about ourselves, right? Yeah. So good. So good.
I hope you found this episode as inspirational and kick-ass as I enjoyed interviewing with it. If you love this and you resonated with it, please reach out to the speakers. Their information is in the notes. Feel free to reach out to us. And as always, if you're curious about mentorship and support and business coaching under the Burnout to All Out umbrella, go to burnouttoallout.co and check out what we have going on in the business mentorship world today, including business coaching and retreats that are live and experiential and take a 360-degree approach to business. We can't wait to see you on the other side, wherever we collide.